The price of KCB today was ranging between 68 and 69, as this viewer has indicated. When prices fall, what do? There's something we call averaging down, as I've talked about it in many of my videos. And maybe some of you, they hear the word averaging down, wanasikia they don't understand what is averaging down. So, what is averaging down? Is a strategy of buying additional shares of stock as the price declines. And the goal is to reduce your overall cost per share. And this is something, a time like now when the stock prices are coming down, the counters, not only in the banks, the counters, the prices are going down. This is a strategy that you're supposed to apply now. You can remember last week, the KCB share was at 71. Today is at 68. I can remember even last week, Thursday, it hit 66.5. So the prices might continue going down. We don't know. Because even today when I checked, the foreigners are still selling the banks, not buying. If you check at the proportion of what they are selling and what they are buying, even last week on Friday, it was the same thing. They are selling more than buying. And that's why the prices are continuing to dip. So what do? As a smart investor, you average down. But how do you average down? One, you have to pick the stock that you're going to average down. It's not all stocks that you average down. And if you're there and you don't know which counters to buy in Nairobi Security Exchange, I'm still selling my ebook, How to Pick Profitable NSE Shares. It's going for 400 shillings only. The link to purchase is in my bio. Back to averaging. Something like uchumi going down, that one you don't average down all every day. It's for those strong companies which are fundamentally strong. So first of all, identify those companies that you're going to average down. And averaging down in this way, not that when KCB imetoka 80, sahi iko 71, and maybe you had set aside 100,000. You go in all at one at 71. No, you stagger the purchase of the KCB. If KCB goes down by 5%, and maybe you had set aside a budget of 100K to buy that KCB counter that you have identified at the beginning, you buy 5%. You buy 5% of the money that you have set aside, 5% of 100, that is around 5,000. So you buy more shares of KCB at 5,000. Assume now KCB continue going down, and now it's around 20% of your portfolio. From the 100K that you had set aside, get 20% of that 100, that is 20,000. Buy more of KCB. And why does this one work? You are avoiding putting all your money when you think the price now, it may hit rock bottom, then you put all your money all together. No, because you don't know how the market will behave. Maybe it will continue going down. So at the moment that it has reached that 20%, you add more. This is called intentional position building, because a typically 20% drop is more of, it reflects there is market fear, there is sector-wide pressure, we don't know what is happening, there is short-term uncertainty that like what is happening currently in the market. But for strong company, this often where real value begins to emerge. That's why I'm telling you, when it goes down by 20%, buy 20% of your portfolio allocation. Assume it will continue going down to above 50%. This where you aggressively buy, because this is where the greatest opportunity is. Because these are, you are still remembering, these are good companies. They have dropped by 50%. It's like a once in a cycle opportunity. So you buy aggressively at this stage, because every time you buy, your entry price is coming down. So anytime the market recovers, it recovers, you are in good capital gains. But it's not all companies that you average down, as I have said, because some companies, I've given example of Uchumi, I've given example of Efaridi. When they go down and they are not so strong company, why would you average down? Yes, so you must confirm when you're averaging down that the company is still fundamentally strong. The earning potential still remains intact, and if not intact, they are growing. And the decline in the price of shares is not due to permanent damage. If those conditions are met, this is where long-term wealth is built. And why average down a time like now? I think it replaces emotions with a structure. You come up with your own structure. You are no longer reacting to the market, but you are executing a plan. Come up with your plan. If it's 5%, 20%, 50%, or come up with 80%, 10%, 20%, 30%. Come up with a plan how you're going to average down. It protects you from early mistakes. So you avoid heavy losses by pure timing, or putting all your money at once at the beginning and you don't know whether the market will continue going down. Then it maximizes value over opportunity. Your largest investment happens when prices are deeply discounted. And then when does averaging down becomes dangerous? It becomes dangerous when price decline is happening because there is consistent decline in profits, there is unsustainable debt levels, maybe there are dividend cuts or suspension, or there is questionable management or long-term industry decline. So, in other words, what I'm saying, it's not any counter in Nairobi Security Exchange is worthy the averaging down. Pick your stocks, maybe 3 or 4, and a time like now is a good opportunity for you to average down and bring that entry price. Maybe you entered KCB at 80. To bring it down, you can even bring it down to 55 or even 50. Thank you.